Welcome back. Well, the sector that's really on fire in the last 10 to 15 minutes has been cement, the cement stocks, the larger name that is ACC, Ambuja. You have, Shree Cement. All of them have moved to the high point of the day. Keep in mind, stocks like Shree Cement and Ultimax Cement, they have seen a big correction from the recent peak. But ACC and Ambuja, well, they are trending ahead. Their open offer is virtually closed out now. And the price is much lower than what, the stocks are trading at. To understand what's going on in the sector and how to approach these stocks, we're joined by Aditya Sirogi, the Chief Financial Officer at Birla Corporation, as well as Rajesh Ravi, Institutional Research Analyst at HDFC Securities, who joins in. Good morning, gentlemen. Thanks so much for joining in. Mr. Sirogi, I'll come to you in just a bit. For the time being, I want to focus on how to approach these stocks. Rajesh, tell us, this move on ACC and Ambuja Cements is absolutely spectacular. The stocks have underperformed in capacity and stock performance as well, if you look at it in the last 10 years or so. But now they've come to the party. How do you approach both these two names? And given that ACC has valuation comfort, would you prefer that in comparison to Ambuja?
Yeah, hi, good morning. You're right. Among the two stocks, ACC and Ambuja, the valuations is much comfortable in case of ACC, while Ambuja on a standalone basis is trading north of $180, $190. So we obviously believe that ACC has more valuation comfort as a standalone entity. The stock is trading at less than $110, $120 today, at $120 per ton. So we find ACC to be more comfortable and more. We find there is a more upside in case of ACC versus Ambuja. Yeah.
Okay. Aditya Sirogi, who is the Chief Financial Officer at Birla Corp, also is joining in. Mr. Sirogi, good morning and welcome to the show. Can you quantify for us what has the price fall been so far in Q2 of FY23? And have you attempted any price increase from your end?
See, the price fall would vary from region to region, but my sense is it will be in the range of 150 to 250 rupees per ton.
Okay. All right.
And coming to the second part of the question,
any price increases?
We have recently increased price in the eastern and the western regions to the tune of 15 to 20 rupees.
All right. So that was in the month of September, Mr. Sirogi. And do you believe that demand on ground is strong enough to absorb this 15 to 20 rupees?
Yes, at this moment, that is our expectation.
Okay. All right. What about volumes? In the past, you've told us that volume should grow by close to around 15% in FY23. No worries on that front. We had a couple of months where there was a lull in this year so far. Obviously, monsoons as well taken into account. But 15% volume growth, is that doable?
Yes, definitely it is doable. Monsoon is typically a weak season from a demand point of view. And this year, because of slightly higher monsoons, the demand was tepid. But thanks to the good monsoon in the coming months, we expect the demand to pick up meaningfully.
I think also why Nigel was asking you, is it doable, is because we've seen, unseasonal monsoons. We've seen flooding across many states, the latest being, of course, what's happening in Bengaluru. We've seen a drought situation as well. All this perhaps would put a lot of infrastructure projects on hold. Would that be a concern? Rajesh, I wanted to come to you on this.
Can you rephrase the question? I didn't get you. What you're trying to...
So I'm trying to ask you about whether these demand trends, right? 15 to 20% growth is what Mr. Sirogi is talking about. But do you think that would be a challenge given what's happening with the monsoon situation?
So, this monsoon is, in our understanding, this is a normal phenomenon. Most of the August and September, there is heavy rainfalls across parts of India. So obviously demand takes a hit during the monsoon quarters, and as September onward monsoon starts to recede, construction activities picks up, and that is where the incremental demand starts to get factored in the December and March quarter. So I don't see any big risk to demand getting impacted from a H2 perspective.
Rajesh, since we're talking about stocks, couple of these companies from the broader markets, the smaller mid-sized companies, so to call it Sanghi Industries, India Cements as well. I think if I look at a margin performance, they deliver the worst margins, in quarter one but they have rallied the most, post their numbers. How would you approach some of these names? Do you believe some of them are acquisition targets for these larger names?
So yeah, what is happening is that there's a lot of hopes and expectations that the market will see renewed M&A activities post, the Adanis coming into the fray, and even they talking about adding, close to 40 to 60 million ton capacities over next few years. So, and even the bigger guys, other bigger guys are also become aggressive. So, what we understand that given that the industry, the among the listed space primarily, balance sheet remains a big concern from a minority shareholder perspective. So, and many of these companies are facing balance sheet issues. So, if we look from that perspective, are they a good target for an acquisition? Yes, people would be looking at these companies, and different companies, bigger companies have been talking about that they are scouting for assets. Uh, and I believe unless a company is under stress, I don't think they would be coming in for a sale in the cement industry. We have seen there are multiple small companies operating out of South India, and none of them have been on block, primarily because they don't have balance sheet concerns. So wherever there is a balance sheet concerns, and given that the bigger guys are growing at a faster pace, things may turn bad for smaller companies who are also riddled with balance sheet. So from that perspective, the market may be factoring in that these could be acquired, and in case of an acquisition, see, all M&As that we have seen in the last few years are not below $100, whereas most of these stocks are trading well below $100, $50 to $60. Most of the small cap names, they are trading at $50 to $60. So it is that hope of these assets may come up for sale eventually, will be fueling rally in these stocks.
Okay, in fact, Mr. Saraogi, I wanted to pose that question to you as well. Are you looking at any inorganic growth at this point in time? Earlier, you had told us that you're looking at fully utilizing your existing 20 million ton capacity. So is it just going to be organic growth for you, or are you on the prowl?
No. Currently, we are not looking at any inorganic opportunities.
But, Mr. Saraogi, why is that? If you're going to be setting up capacity at $100 per ton, and there are some of these companies that are available at $60, $70 per ton, maybe some of them even below that. Won't it be, an attractive proposition to go out there, engage with some of these promoters, and pick up the capacity, getting a ready running capacity at a cheaper price? Why wouldn't you do that?
See, you are absolutely correct. From an industry standpoint, it might make sense. But coming to my company specifically, we have just completed a major capacity expansion from 15 million to 20 million tons. So our balance sheet would not allow any further major expansion at this juncture. Maybe a couple of years down the line, we can definitely look at that.
Okay, so let's talk about your balance sheet then. I think the last reported number, your debt was closer to around 3,700 to 3,800 crores odd. So what is the outlook out here? Will you be looking at debt reduction, say in FY24? If yes, by how much? And you're at 20 million tons. You want to go to 30 million tons, right?
Correct.
How is that? How much of that is going to be organic as of now? How much of that could possibly be inorganic?
All of it or most of it is planned to be organic. And in terms of debt, we have always maintained that we would like to be within a debt EBITDA level of 3. So that is our philosophy in terms of leverage.
So debt will continue to remain around 4,000 crores then, approximately.
Yeah. So instead of reducing debt, we would like to use the resources for capacity expansion.
Okay, got that. By the way, the cement stocks are on fire this morning. Perhaps listening in to both of you and the demand uptick that you're talking about. ACC is the top mover right now, up almost 4%. Ambuja Cements is up almost 3.5%. There's a big comeback here, and you've also seen players like India Cements do quite well, up about 2.5 to 3 odd %. Mr. Saraogi, on the EBITDA side, I wanted to talk about the expenses because power fuel costs have gone up, freight costs have gone up, logistics, etc. And that has put pressure on your EBITDA per ton. Do you think that there would be some respite in the next couple of quarters? And on an average, what are you looking at?
See, this quarter, the costs have been higher because although the pet coke prices have corrected by 25-30%, quite significant in this quarter, but most of the fuel that we are going to, most of the companies are going to use would be those procured in the previous quarter when the fuel were ruling at very, very high prices of north of $270. So we will see the impact of the reduction in fuel prices coming through in Q3 and onwards.
Okay. All right. Mr. Sarogi, final question before we let you go. You're not interested in inorganic growth, but what if someone says that you are yourself, your company is trading at $75 per ton or less than that? Suppose there's a takeover. You would have engaged with the promoter. Any thoughts on that?
See, there is a promoter to decide, but I don't think that they would be interested in selling.
Okay. Well, thanks a lot, gentlemen, for joining in. This space has been buzzing, and that's Birla Corp and HDFC Securities telling us that demand is very good despite what's happening with the monsoon situation. A 15 to 20% growth is what you can easily expect in the cement industry for FY23. The other space that we're looking at is the tire stocks. They have been on fire, no other way to put it. 52-week highs on most of them, whether it's Seat, Apollo tires, or even something like a JK tires. There's obviously demand coming in from auto OEMs with all the new launches, but not just that, raw material prices have cooled off and improving sales of high margin SUVs and commercial vehicles have aided the operational performance. Kumar Subaya, who is the CFO at Seat, joins us now to talk about that. Mr. Subaya, good morning and thanks a lot for being with us on CNBC TV18. First, on the demand situation, there's a big resurgence that we're seeing across the board and you supply to almost all categories. So just tell us, between passenger vehicles, two-wheelers and commercial vehicles, where is the maximum amount of traction now and what do you see as a year-end growth for the industry and for Seat?
Okay, good morning, Sonia.
Morning.
Overall, at the business units level, we are seeing traction and replacement and more in OEMs. And as far as export is concerned, we are seeing some headwinds, particularly from Europe. So OEMs and replacement growth has been steady for the last 5 to 6 months or so. And with respect to categories, passenger vehicles, two-wheeler tires, we have seen growth. In case of truck and bus, radial side, more with OEMs, we have seen growth, but otherwise in the replacement market, it has been steady since February. That's the way the market stacks up.
Okay, so if you can give us some numbers, right? I mean, in Q1, your overall volume growth was up 7.5% quarter on quarter. Can you do this kind of growth for the remaining quarters, about, high single digit to perhaps double digit? And for the full year, brokerages like Nomura have forecasted about 12.5 to 13% volume growth. Is that a reasonable assumption?
See, quarter one normally is the average revenue is more than the other quarters. So therefore, quarter four and quarter one, we normally tend to sell more. And therefore, on quarter, it is difficult to deliver that kind of a growth in quarter two and quarter three. Normally during monsoon, the tire demand tapers down. So therefore, difficult to sustain. But overall, year-on-year basis, okay, we would have strong growth in the current year versus last year. I think I expect it to be in the double digits, high double digits. That would include both value growth as well as volume growth. That's the way we expect the current year's growth to be.
Volumes in double digits, well, that's more or less in line with what the brokerages are estimating. A couple of questions, Mr. Subaya. What's your current mix? I think earlier higher amount of your sales was in replacement market. If you could give us a breakup of replacement, OEM, as well as exports. That's the first part. And also margins. That's been the worrying factor. It's come down to single digits or mid-single digits. The last time you delivered double digits was 4 quarters ago. When do you get back to double digits on both these two aspects? Go ahead.
Okay, as far as the overall broad mix is concerned, OEMs have been growing faster than the other business units. Currently, the mix of OEM is approximately around 25 to 26%, and exports is around 20%, and replacement is around 54-55%. That's the way it has been. But the growth is more in OEMs. With respect to margins, you are right. Okay, it's more than 4 quarters since we reported double-digit margins. And in the last 4 quarters, we have seen unprecedented increase in raw material costs. We see that softening. Okay, our general approach would be to get it to double digits. We hope with softness in raw material prices and some price increase that we have taken in Q2, we hope to achieve it in due course of time. I'm not able to tell you the time frame, but we are seeing some correction in commodity prices.
Mr. Subbiah, sometime in FY23 you get to double digits? Quarter four you say is very seasonally strong, right? I mean, Q1 and Q4 are your best quarters. So maybe by Q4, given that, operating leverage will play out, input costs will cool off, double digits possible by the end of this fiscal?
No, it is possible.
Okay, double-digit margins by the end of this fiscal. That's good to know. I guess the other reason why companies like yours could see better margins is because there's this wave of premiumization playing out, right? Tires with the more safety features, better technology, etc. And say Apollo Tires, for example, launched their Reddy tires last year, and that's 40% more expensive than Apollo Tires itself. At your end, are you benefiting from premiumization? And if yes, how much would that help you with your margins?
Okay, from our side, there's a lot of focus on higher inch tires, which normally go into premium vehicles. And as a percentage of our total share, we are seeing improvement in, say, 14 or 15 inches plus kind of tires. Okay, but we don't have the kind of a product that you mentioned that one of the competitors has, where they price it at 30 or 40% premium. Okay, our range of products, various products with our own CEAT brand name, with different platforms, earn different margins. So we are seeing with higher sales of SUV vehicles and its impact on the replacement, we expect the overall margins as a mix to move up in the coming quarters.
Okay. Just, to talk a little bit about exports, we are seeing a lot of pressure in markets like Africa, Europe, and 20% of your own revenues comes from exports. Do you think that could put pressure on your overall business?
Yeah, it is. In fact, last year there was a quantum jump in terms of our export share on the total value of the business. Exports grew very strongly last year, close to about 50% or so. But in the last 3-4 months, we are seeing some headwinds, specifically in Europe, and also in addition to Africa, some of our own neighboring countries also. So where due to currency availability issues, our own sales to Nepal, Sri Lanka, Bangladesh, we have seen some correction in addition to Europe and Africa. So we are seeing that in the current quarter also. We expect it to have some impact on our total growth in the current year, if it sustains.
All right, Mr. Subbiah, tell us what are the current capacity utilization levels that you're functioning at? That's point number one. Point number two is your capex. I think you lined up close to 1,000 crore capex. Could you confirm that? And what does it do to your debt levels, peak debt levels?
Okay, our capacity utilization, including bias categories of tires where there is a decline, say truck and bus bias, it's around 80 to 83% level. It varies from quarter to quarter. The newer ones, the radial side, the capacity utilization is more. The truck and bus bias, farm bias, utilization is a little less, and average works out to around 82 to 83% of our available capacity. With respect to your second question on capex, the capex outlook that we gave in the beginning of the year for the current year is about 750 crores of project capex and about 150 to 200 crores of routine capex. Okay, and we keep reviewing this capex on quarter-on-quarter basis depending on our operational cash flow and overall debt levels. So therefore, as we stand by that earlier estimate. With respect to debt, and in Q1, we maintain our debt level more or less in line with where we were as of end of Q4. So it's approximately about 2,100 crores. And we spent about 250 crores of capex in Q1. So a lot of that capex that we incurred in Q1 was managed through our own internal accruals and efficiencies in working capital. So internally, we have a threshold of keeping our capex at, say, less than debt equity of 1 and debt EBITDA of around 3. So we continue to follow the discipline going forward. We would continue to follow.
Okay, but on the debt, this almost 2,100 crores is something that you ended FY22 with as well. And now with your capex, perhaps, the fear is that there could be more debt, incremental debt taking on board. Any plans to reduce it at all?
See, in quarter one, what happened, we incurred 250 crores and we still maintained at 2100 crores. That was a number that we ended up as of 31st March too. So therefore, it's more about how much capex that we incur in balance part of the year. We expect our debt level to move up. We have not cut down any of our project capex as of now. So except truck and bus radial tires that we have pushed it by a couple of quarters, that was announced earlier. So we expect debt level to move up during the course of the year in line with our incremental project capex. Okay, however, it will be managed well within that overall debt EBITDA number of around 3 is what we are aiming at. So if you can afford and if you can generate more operational cash flow, we will incur that capex. In the event we see some downsides, we would cut our capex. That is the approach. So we don't expect our capex debt to come down in the current year. It could marginally go up in the coming quarters.
Okay, so just one last number on the top line. What are you looking at by the end of the year? 10%, 12%? Can you even do 15%?
Okay, see, quarter one, we grew by 50% over the same quarter of last year. But however, I just want to highlight last year, quarter one, we were impacted by wave 2 of COVID. So therefore, it's not a clear comparison. I think we expect a strong double-digit growth in the current year, assuming that there is no impact on account of pandemic in the current year. So as we said, a volume plus value growth would be high double-digit number, anywhere between around 15% types is what we are looking at this point in time.
That's great, and all the best to achieve that. So it's a 15% growth on the top line, double-digit margins by FY23. Very optimistic comments from the management, but some challenges in exports. Let's slip into a quick break. Mitesh Thakkar will join in for some technical trades in a bit. Stay tuned.
Welcome back. Well, the markets respected the script so far. The gap down getting bought a bit, and the mid-cap index has moved comfortably in the green now. Now just keep an eye on the bank Nifty. It's showing signs of some kind of a bounce, a durable bounce. And, if it can take out the first hour high, then perhaps possible to see maybe another up move on the bank Nifty as well, trading above the intraday pivot as well. So looking quite interesting over there. The broader market has been doing well. Advanced decline looking strong. Mitesh Thakkar is back with us. Mitesh, the first dip has been sort of bought a bit. We are not at the lows of the morning, but your thoughts on how to approach it incrementally and your stock calls now. Mitesh? Sorry, Mitesh, you're on mute. I think you're on mute, Mitesh. So,
yeah,
Mitesh, go ahead. Your call on the index now and your stock calls.
So I think the call on the index remains very similar to what I discussed in the morning. Basically, it's 17,400, 17,750 kind of a range, and we are still in middle of that, so not taking an index trade. But the good thing is that, today's bounce back also confirms that there's good demand waiting at lower levels. So I think declines will be bought into. I would prefer buying closer to or just below 17,450. We didn't get that level as the SGX was indicating. But I think around that level, I think would be a good risk-reward equation to enter a fresh long trade on the index. On the stock side, though, I have a sell on LTTS. Disclaimer, we have some positions over there. It's broken down with the gap. So keep a stop about 36,110 over here. Look for targets of around 3480. And a buy on Petronet, which is showing a very strong price volume action in the first hour of the day. It's a buy with a stop below levels of 215 for targets of 225.
Okay, Mitesh, thanks a lot for those calls. The Nifty low is 17,484. The level we were watching out for was 17,475, purely from the risk reward point of view. So that clearly, once again, emerges as your line in sand, the 20-day exponential moving average. The market just respected it so many days. Even on bad days, it's respected that. And today looks like at least that's the case. But let's go close to Manisha for an update on the commodity markets. Manisha, hi, morning, welcome back. What are you tracking?
Anuj, thank you so much for that. I'm looking at the coal prices because we have seen a very sharp rebound onto that one. We started this year for coal prices at $157 per ton, and we are trading at an all-time highs of $460 per ton right now. So more than doubling in case of prices is what we've seen onto this one. That is the Asia Newcastle future prices that I'm talking about. But the Europe coal prices also are inching towards all-time highs. So we are looking at strong demand, persistent supply disruptions, and that clearly has been supportive. It all really boils down to China as well, because nearly 50% of global coal consumption comes in from China, and the drought there has led to lack of hydroelectric generation, and that has led to higher coal prices as well. There has been an interesting IEA report which talks about the global coal demand in 2022, and it says that it could hit a record highs. Last time we saw consumption hit a record high was all the way in 2019. So after that many years is what we are looking at a strong demand as well. Not just that, the Europe and US also are turning to coal as the gas prices have been surging as well. We've seen nearly 35% of gains in gas prices in this week itself, and that in turn has been supporting the coal prices also. The IEA report also talks about on what they are seeing as demand from the European markets. Last year was a 14% of jump in consumption. This year, another 7% of a gain is what they're anticipating. For the Indian markets as well, for the current year, 10% of global demand growth. Demand growth is what we are seeing for 2022 as well. When you look at the prices, then it has been a strong gain in the coal prices. On a week-on-week basis, we are up by nearly 8 to 10% there. On a month-on-month basis, 21% up. And in last 12 months, 155% of gains is what we've seen in coal prices. Most of the experts feel that if the kind of demand that we are seeing right now continues to be like that, then we are headed towards $480, $500 per ton kind of levels in case of coal.
Okay, thanks a lot for that, Manisha, and good to have you back. Well, let's talk about some more buzzing stocks. Vahishta is with us to talk about the defense sector, which has been on fire. There's a Morgan Stanley note there. Vahishta, what do you have?
Hi, Sonia. Thanks for that. Yes, that's right. Morgan Stanley has released a report on rising indigenization for the defense players. Now, remember, this sector has been in flavor for quite some time now. They say that there has been an existing order book which provides a multi-year earnings visibility for these companies. Also, the government is progressively banning imports. There is also a scope for increasing exports and diversifying the revenues. Now, on Hindustan Aeronautics, Morgan Stanley says that there's a current order book of approximately 850 billion rupees as on August 2022, which provides a visibility of more than 7 years. Hindustan Aeronautics has a strong ordering visibility of 1.2 trillion rupees over the next 3 years, which is coming from manufacturing, engines and repair and overhaul segment combined. Morgan Stanley has an overweight rating on the stock with a target price which has been raised to 3,024 rupees. Now moving on to Bharat Electronics, whose current order book is at approximately 590 billion rupees, which provides a 3 years growth visibility for the company. Also, there's a strong ordering visibility to the tune of approximately 1 trillion rupees from domestic defense and export-led opportunities over the next 2 to 3 years. There are multiple avenues even in the non-defense segment. Now, Bharat Electronic products which were added to the indigenization list have 1.9 trillion rupees of prospects over the next 5 years. Morgan Stanley has an overweight rating also on the stock, and the target price has been raised to 373 rupees. Also, there are some risks to these stocks which have been pointed out, which says that there's been a dependency on private sector to execute products on their behalf, and there could be an inability of supply chain to cope with a large indigenization opportunity, which could lead to lower earnings. Now, remember, these stocks have already run up quite a bit in the ongoing calendar year. Bharat Electronics had run up by approximately 55%, while the Hindustan Aeronautics had nearly doubled in this ongoing calendar year.
All right, Vahishta, thanks a lot for that. Let's go across to Nimesh now to talk about the block deal that took place in CG Power. Nimesh, over to you.
Hi, Sonia. So as you rightly pointed out, there was a large block in CG Power. It actually got done in the block window. And what I understand from sources, Standard Chartered Bank has sold its entire 1.3 crore shares in CG Power today. In terms of buyers, I believe it's a combination of domestic mutual funds as well as insurance companies who participated and bought in today's block. The feedback is there was a strong demand from some global investors as well, but it was largely been subscribed by the domestic funds. Now, if you look at the shareholding pattern, as of June ended, the mutual fund exposure is just 3% in CG Power. So that will go up by another 1% after today's block deal. And the FI is on close to 13% stake. So still, the institutional holding is not that high in CG Power, so in that context. So, but the news is that Standard Chartered Bank has sold out its entire 1.3 crore shares. So it's a clean out trade, so to speak. And in terms of buyers, as I said, a combination of domestic mutual funds and insurance companies were buying in CG Power today.
Okay, all right. Thanks a lot for that, Nimesh. Well, time to slip into a short break. On the other side, though, we'll get chatting with Mr. Piramal of VIP Industries. Stay with us. Well, a theme we have been talking about is the recovery in the domestic and international travel. Hotel stocks have been buzzing on hopes of strong demand in the festive season. Today, we speak to another potential beneficiary and the country's largest luggage manufacturing company, Mr. Dilip Piramal, Chairman at VIP Industries. Hi, Mr. Piramal. Thanks so much for joining in. Well, how's demand on the ground? Strong enough? And if you could tell us whether or not you stick to that, guidance you'd given us earlier, revenues of close to around 2,000 crores and margins at mid-teen levels.
Yes, I think we are on track to do that. And we're trying to improve it, but let us see. I mean, so far we are on track.
And demand is strong enough is what you're indicating. Then have you pushed through any kind of price increases? I recall in Q4 you had pushed through a 5% price increase. And I think in Q1 as well, it was in the vicinity of around 2%.
Yes.
Q2, another price increase?
No, I don't think there is any need, but because I think prices are now sort of stabilizing, and in some rare cases they're coming down also.
Okay.
So, and increased volumes over the last year, things are looking quite all right.
Okay. Mr. Piramal, good morning. This is Sonia here. It's so good to see finally things are back to normal, right? I mean, it's been 3 really challenging years. But can you give us some color on demand? Domestic travel, international travel, school bags, the wedding season is back in a big way. So what is the color of the growth that you're seeing, and what kind of sustainable growth do you see over the next 1 to 2 years?
See, the percentage of growth is not very relevant because we are taking from a very low base or lower base, So I would say that if things were normal, we would be having about 10% growth.
Okay. And a 10% growth, I mean, you had targeted around 2,000 crore revenues in FY23. Do you stick to that guidance?
The 10% is if things were normal, because now the growth level is much higher. In some cases, they're 50%.
Okay.
Because the last year was not a normal year. So very difficult to say the percentage of growth. So we are looking at absolute figures now for the time being. Of course, we have it for comparison, but that doesn't mean much. If we've grown 50% in a particular segment or overall also, then that doesn't mean anything. We are not getting elated about that. But the absolute figures are more important.
Okay, all right.
So the 2,000 target is more relevant for us.
Are you seeing more premium products being sold?
No, not as yet, because actually we've had some supply problems. They're not problems, but you see what has happened in this COVID period, that our manufacturing has all come back to for us in India and Bangladesh, which means the number of items, SKUs, has gone up tremendously.
Yes.
Earlier on, let's say we are buying from about 10 vendors in China, and now we are making all of that ourselves. So that is a very massive increase. So there are some issues there. So, but it's the premium products which were not selling so much in the COVID period are back there, and it's sort of more or less normal now. I wouldn't say that there is a particular increase in the premium products, but that can happen maybe after 6 months when the availability is much better.
Okay, all right. Mr. Piramal, a smaller peer of yours, that was Safari, they have been growing as well at a fast clip. And
yes,
some of your competitors, maybe they're pulling away market share from you. You had indicated that your market share, had come down a little bit, I think to around 47% or thereabouts. But you wanted it to get back to around 50%. Is that happening? Are you holding on to your market share?
Well, actually, in the last quarter, I think we have gained 1% market share.
Okay.
No doubt our competitors are doing quite well. So I think that means that the overall market is increasing. Or maybe we've got some market share from the unorganized sector. The unorganized sector has been badly affected because their supplies came mainly from China. And I don't think they've been able to replace that so fast. But there is some ambiguity there because we know that the competitors are doing quite well. But our actual market share after, one of our larger competitors, Samsonite, their figures come out only 6 monthly because they're not a listed company. And except for us and Safari, nobody else is listed. So the information is not as accurate as we would like it to be. But we have verified and we have actually gained 1% market share in the last quarter. And that's the situation.
Okay. But from personal experience, I must tell you that after not traveling for 2.5 years, a lot of your luggage goes bad, right? I mean, it starts falling apart. So you have to, now that people have started traveling, you have to replace it. I guess there's outsized demand there itself.
Yeah. Yeah, we see the results of all that. And the domestic travel is at a very high level, but international travel is still not picked up so much. There are restrictions. There are not so many flights today.
Yeah.
Like Air India is very suppressed. They've, I think, given out a lot of their planes which were on lease. So the capacities are quite low. But domestic travel is at a very high, and also domestic rates are very high. They're coming down now. So all in all, it looks for a good, good season, good future prospects.
Okay, good future prospects. Hopefully, international travel will also pick up very fast, as much as domestic travel, and things will get better for you. Mr. Perumal, thanks a lot for joining in and giving us a quick take on the business as well as the way forward. So they hold on to their 2,000 crore revenue target for the full year, and demand has picked up, they say. Let's wrap up with Bazaar on that note. Lots of trading ideas lined up for you on our next show, Chartbusters.